There are basically 5 categories. 1 would be fast growers, 2 would be slow growers, 3 would be cyclicals, 4 would be asset plays, and the 5th one would be turnaround. The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money. One way you can look at growth companies is think of baseball. A normal baseball game has 9 innings. You should look at a growth company and say, I don't want to buy it when they're in the first inning. I want to buy it when they're in the second or third inning. They've got the formula right. They've got lots of room to go. So you want to say to yourself, this is a company that's very early in its cycle, like a McDonald's when they're only in a few stores, or limited when they're only in 100 stores. And they had lots of malls to go to. Somebody would say to you, I'm going to sell you a business for $100,000. And they're earning $50,000 a year. You say, what's the bad news? Let's say the bad news is the earnings are never going to grow. They earn $50,000 a year forever. So this is a price earnings multiple of 2. You pay $100,000 for $50,000 of earnings, but they're never going to grow. You say, I don't care. I'm going to get a $50,000 return every year. In 2 years, I get all my money back, and then I'm going to make $50,000 a year on my $100,000 investment forever. Just don't buy in the hope. Wait for things to get better. Prices to get better, capacity to shrink, inventories to go down, scrap prices to get better. Something ought to be happening. So you just want to wait for something really to happen, and then when it happens, it's going to be big. If it's a cyclical, you're hoping for a dramatic turnaround in earnings. It's going to happen over 2 or 3 years. Earnings are going to go from a loss to a huge profit. Stock's going to go up and you're going to get out. It's all internal. They're doing something, either new product, new management, cutting costs, getting rid of something inside the company that allows them to improve themselves. The turnaround, you had plenty of time. So just don't buy on the hope. Wait for the reality. Turnarounds are so big, it's worth waiting to get some real evidence. S.S. Kresge was a company going nowhere, in real trouble. They invented the Kmart formula. They rolled it out across the country. The stock went up over 50-fold. Kmart became a massive stock. Walt Disney is an example of an asset play. After they'd opened up Disney World and after they'd opened up Epcot, the company's growth rate sort of slowed down. They weren't growing very fast. And then they discovered there was a lot of assets inside the company. There was the name Walt Disney. They started the Disney Channel. They started selling things that they sold at Disney World and at Disneyland. They started selling them everywhere. They used their licenses for Mickey Mouse and all their characters. Made a fortune on that. These are on the books for nothing. The company was loaded with assets. In addition, they had all that land inside of Disney World, and everybody had hotels outside of Disney World. They decided to use their land inside to develop more parks, and then even have other companies come in. These companies paid their money to build inside of Epcot or inside of areas of Disney World. The price of a stock will follow the direction of earnings. In almost every case, you can generally state that if a company's earnings go up sharply, the stock's going to go up. If earnings go from very poor to mediocre, the stock's probably going to rise. If they go from mediocre to good, it's probably going to have another rise. If it goes from good to excellent, it's probably going to have another rise. Or if a company's earnings grow dramatically over a long period of time, the stock's probably going to go up dramatically. Price-earnings ratio is something that some people make very complex. It's actually very simple. If a company is selling at $100 a share and they're earning $10, there's a price-earnings multiple of 10. Dividends come from profits. If a company earns $5 a share, they have the choice of paying out some of it to the shareholders in the form of a cash dividend. They'll be able to put it down in 2 paragraphs. It could be something like earnings are turning around, a new product, somebody's gone out of business that was competing with them, they've just discovered oil, they've got new management, their balance sheet's getting better, they're getting rid of a losing division. There's lots of different elements, but that's what a story is, and that's what you rely on.